session. Futures market closes at 5 Eastern, 4 Central Time. As always, if you're on the platform, Tasty Trade, on the website, tastylive.com. Thanks for joining us. Come on over to YouTube. Tell us what you're trading. Okay, so today was a mixed day, right? We have bond yields that are going lower for bad reason. Jolts come in weaker than expected. Fed cut odds move up for September, October, and December. But the stock market isn't all that bothered. Dylan's call for being bullish on Google yesterday is realized almost instantaneously with it shot up higher following the antitrust case that helps the NASDAQ move back to the upside. And perhaps indicative, if you're one of these mega tech companies, do you really have to be worried about antitrust moving forward? In any event, gold and silver keep running, which is perhaps the biggest story of the day. Volatility in the currency space exploding to the upside. What does that mean? Oil back to a familiar place, and so much more to discuss over the next hour. Dylan, we have you a little bit on limited time here today. You're going to abscond and make your way across the globe as our resident Carmen Sandiego. So let's go with you first. Stock market rebound, inside day, limited action. People are out buying the dip already after yesterday morning's sell-off. Is that it for the month of September? Was this the shot the Bears had?
No, definitely not it. You're guaranteed to have at least one big spook show. Remember, you got a jobs number coming, you have a CPI number coming, you have a whole list of awful things that could happen out there. And you have, at this point, the foregone conclusion of a rate cut that may end up actually being a negative, because I agree with what Tom was saying, which is so let's say we navigate the jobs number, toss it aside, navigate the inflation data, toss it aside, then you're going to get this rate cut. And then all of a sudden, I think that's the biggest risk to the stock market, is you're going to get this rate cut, and everybody's going to look at the rate cut, which has now been, we're going to need the rate cut, we want the rate cut, all the things for the last few months. And then everyone's going to say, hang on, why are they cutting rates? Oh, because they're expecting a slowing economy. So a rate cut is not very much of a code language, but code language in some world for the central bank is anticipating economic weakness and feels compelled to reduce rates. And that economic weakness is being driven by idiotic and chaotic economic policy from one Donald J. Trump, president of the United States. And so I do believe you're going to get one real barn burner of a sell-off at some point between now and I think the most likely location for it is the cut itself, but you also have the possibility of a really hot jobs number or a really hot inflation number, and all of a sudden they're like, oh, maybe the certainty of the rate cut is off. Maybe inflation is so strong and that maybe they won't do it. And so I just think there's plenty of opportunity for getting your face kicked in here. And as far as today's rally is concerned, for my money, for as much as I'd like to pat myself on the back for my Google love had absolutely nothing with anticipating a ruling like the one that we saw here with the gap higher. So I take zero credit of it, or I take zero validation, I guess I would say, from the Google move, because it was unrelated to my entire thesis, which is that I believe Gemini and Google itself is going to be a dominant piece of the AI landscape, and that has nothing to do with a judicial ruling, which is obviously great for the stock, but unrelated to my thesis. So I think that this thing's going to get pounded at some point in the next few weeks, but I don't have the skills to trade the short side into situations like that, but I'm more than happy to hang around and look to buy some of my favorite names like Meta, Microsoft, et cetera, at lower prices when it happens.
My God, he sounds like me.
Dylan, it's interesting that you point this out about Gemini.
Short though. Sorry, go ahead, Chris.
Oh yes, I am willing to get short, but I think our reasoning for what there stands to pull the rug out from under everybody is basically on point. It's that there's all these rate cuts that the markets now have baked in, especially for next year. I think this year is kind of a given already. We got 3 meetings left. The markets and the Fed have both settled on 50 basis points going back to May, and they haven't really come off that very much. With only 3 meetings left, there's but so many ways you can put together 50 basis points and rate cuts. I think the biggest issue now is what happens next year, because that's where the Fed and the markets are very far apart. The Fed in June said 25 basis points. The market said that's cute, 75 to 80. And that's a big gap. And so if there's anything like a sense that the markets are not going to have the Fed go their way with the summary of economic projections this go around, if they come out in 2 weeks and say, yeah, it's still 25 for next year, I think the markets are going to be very disappointed.
Dylan, I want to circle back to your comment on Google here having the best model. Polymarket judges that to be the case, which it's only September 3rd, so there's a long way to go over the course of the month. But quickly here, Artificial Analysis, independent auditor of the AI models that are currently out there, they test for 3 different things: intelligence, speed, and price. And you see Google not at the top for intelligence, but in terms of speed and price, it's very efficient.
Well, not only that, Google is the only one
particularly for the Flash model here.
Yeah. Well, Google's the only one that already has an embedded system to monetize it as well. Like, because the other thing is, like, because Google obviously has been doing paid search for so long, GPT doesn't have a way to make money by embedding cash flow from corporations that want to buy keywords on car sales, on cruise lines, on, you know, all the things that people buy advertising for. But boy, Google does. And they have not only they have a very impressive AI product, they are by far the best positioned to make money from their AI product.
Well, they've certainly been a leader here today at 9.12%. You can't ignore that. And what did I do? Got to get rid of those lines on the screen, figuring out this new Zoom setup. Either way, though, Ilya, it's a modest gain here for the NASDAQ, up 0.78%, the S&P up 0.54%. So we find ourselves looking at we'll just get rid of you, clear all my drawings. There we go. We find ourselves looking at a bit of an inside day, even if the market's poking up here a little bit after hours.
Yeah.
The jobs data that came out today was not good.
No.
Period. End of story. JOLTS job openings north of 7 million is going to be fine. That's still a healthy number, but in missed expectations, meaningfully 7.35 previous, 7.4 expected, comes in at 7.18, 7.17, I believe. In any event, you're looking at a labor market that has forward-looking indicators of weakness around the corner. There's a fine balancing act between the market liking a 25 basis point rate cut and being spooked by the possibility of 50. Is this jobs report this week something that tilts us into the territory of 50 cuts?
I think actually the larger concern here is pointed in the other direction. So one thing to remember about these JOLTS numbers is they're a little bit delayed. These are July numbers. We're already in September. So the important caveat here might very well be that the U.S. economy actually seems to be reaccelerating. And the markets are operating on the idea that the Fed is wrong to worry about inflation. What they should be doing is worried about an economic downturn. And that's why all these rate cuts for next year, right? The underlying story that has underpinned the rally from April's lows is, first, oh, good, the administration is responsive to market discipline. If we crack the bond market and the currency market and the stock market all together, all at the same time, with vigor and conviction, the administration will turn around and go, hey, let's pause the tariffs for 90 days. Everybody's getting yippee, take it easy. And then the next thing, once the market sort of settles on, okay, they're not wholly blind, they do see that when they go across the line that we're going to pull them back and they will follow. The next thing is this mounting outlook for 2026 rate cuts, which has been building for months. Whereas, at least since May, the outlook for this year has been fairly steady, few basis points here or there in either direction. So when you look at the architecture here, the risk might very well be not that the economy is weak, but but that the economy is actually speeding up. You saw it in the S&P global PMI numbers. They gave a fairly strong assessment. The ISM numbers this week on the manufacturing side were not as strong as that, but they weren't terribly weak relative to expectations. They did give us a fifth consecutive month of contraction, but that was expected. It was a little bit faster of a contraction than anticipated, but not by much. More importantly, the internals of the report showed you a bounce in new orders that came parallel with a decline in the price component. So there seems to be something under the surface that's on the mend. Citigroup economic surprise data is surging. The Atlanta Fed GDP Now forecast is surging, well in excess of expectations.
3% right now.
Right, well in excess. And forget the reading. Never mind it. The tone of the data going into the model over the past several weeks has clearly been positive, as you can see in its slope. Never mind what the actual forecast is. It's a long, long time until we get third quarter GDP data that we can really hang our hat on.
But directionally, end of July, it's 2.1%, and now it's up to 3%.
Exactly.
Past 5 weeks have given us firmer data.
Exactly. It's the tone of the data. You get the same thing from the Citi Economic Surprise Index. Over the past 2-3 weeks, it's sailing. So perhaps the larger issue here isn't that this late and probably stale JOLTS data is a little soggy. The larger issue may be the markets are operating for months now on the premise that the Fed is going to have to go their way on rate cuts and be a lot more dovish next year. And then the Fed, in just 2 weeks' time, might well come out and say, here's your cut. You've known it's coming for ages. Good luck building a rally on that. In fact, here's your other cut still in the outlook. Good luck building a rally on that. You've known about that one for months. There's your 50 basis points. Next year, we'll give you a quarter of a percent cut. That's it. Good night. Because inflation expectations are still something, as we just saw from the latest Fed minutes, the primary concern. So we're not going to go your way on this expansive outlook for next year. What does that do for stock markets that have absolutely reveled in the building of that outlook, especially over the past month or two? That might be the bigger risk.
Ilya, I saw that the firm, or rather Dylan, because we only have you for about 25 more minutes. I saw that Challenger Gray and Christmas, which Challenger is one of these companies that produces a jobs cuts report. Right now, 10,000 jobs in the economy have been cut explicitly due to AI. We've seen that the college graduation rate for young men is now exceeding that for those with just high school diplomas. Can the stock market run forever if we're reaching a societal tipping point where we're going to have a natural push higher on the unemployment rate? It's a big productivity boom, but it leads to more people without work.
I mean, it's a bigger question than the stock market. Because my personal sense is that entry-level programming jobs, entry-level communications jobs, entry-level marketing jobs, entry-level finance jobs are all going to be in decline. I believe that they'll be in decline to the degree to which that it's going to be more than just a financial crisis. I think it represents a potential social and political crisis. Which I suppose could result in a decline in equity values. I mean, to answer your question directly, but I don't actually, I think that it's much more likely to manifest in other parts of our lives before it does in the stock market. The stock market is extremely efficient at capturing and generating profits. Reducing labor overhead is a move towards efficiency for a corporation. It's not a bad thing in terms of the mathematics of shareholder value, because the yield per employee goes up as the headcount goes down, and as the revenue and profit go up. And so it's a balancing act between, large levels of young male unemployment or young human unemployment, although I do think that the finance programming jobs skew male.
Demographically, sure.
But I don't know does that cause a, I just don't think that the first place that shows up is in Fed rate cuts or the stock market. I feel like that shows up in other parts of our lives in a more physical way. That is, our friends' children, our cousins, our nephews. This is a very real thing.
Well, you mentioned the revenue per employee, or something like the take per employee. NVIDIA is $3.6 million in revenue can be employee. If you think about their total revenues divided by number of employees. For Meta, it's 2.2 million. For Alphabet, 1.9 million. Apple's 4 million. Microsoft, 1.1 million. Like, that's obviously what a lot of these companies are shooting for. I think Valve, the company that makes Steam, they're $19 million in revenue per employee, which is outrageous. I digress though, Dylan. Like, that's ultimately where these companies want to go. If we can clear out the low-hanging fruit. I hate to use that term.
That's the promise of AI, is that the profit of, that's why I think there's a world where the stock market continues to propel itself higher on the efficiency of revenue per employee, at the same time that society, I think that the bigger issue is, how long can we tolerate using the stock market as a measure of economic or national health at a time when it is actually benefiting from things that are negative for society, like widespread young male unemployment?
Well, I think so. There's a problem searching for a solution here, right? And the problem is a demographic shortage of workers, especially as we clamp down on immigration, because the baby boomers are retiring. They're a bigger generation than certainly the one that follows, and even bigger than the millennium generation or millennial generation, which at least in the US is sizable. Elsewhere in the world, it's very, very small, and thereafter it's even smaller, because whereas US millennials decided to have kids for the most part, you're welcome, US labor force, doing my part. But in Europe, in Asia, that's very much not the case. And so you have a shortage even then of labor in the US. In fact, this is the reason why the Fed is constantly talking about maybe the neutral rate on interest rates is actually higher, because we're entering a period of perhaps prolonged deglobalization. That's something that increases costs, as everybody now is learning with these tariffs. Globalization keeps your prices low. Deglobalization brings your prices up. Go ahead and pick at that. But when you look at the demographic aspect, that's a kicker. That makes labor more scarce. That makes the price of labor higher. So if there's a cost saving here from AI, that's perhaps not such a bad thing if you can manage the windfall correctly. And so I think, speaking of globalization, the key here will be, have we gotten any smarter at managing windfalls from economic, sort of economy-wide good things? Have we learned that those things don't distribute evenly, and how we can redistribute those windfalls for the benefit of society at large? Would we be looking at such a controversy about globalization, an unmitigated good thing at the global level, at the economy-wide level, were it not to have costs that are very concentrated for a small part of the population that we decided not to take care of with the windfall from that globalization, to our great error? Would we perhaps, with the windfall of AI, which is a great solution if we can manage it for this labor shortage, will we be better at dispersing the windfall and keeping everybody happy that way?
Hell no.
I can only hope so. But our track record on it isn't great.
Hell no.
Well, you mentioned the demographic issues. I've been pulling up this population pyramid tool, populationpyramid.net, not an endorsement. If they want to
Great
endorse
site,
us, they're more than happy to send us a check. Central America, this is a healthy looking pyramid. Younger generations are bigger than the older ones. You go over to somewhere like Canada, you see it fattens out in the middle, but it's getting skinnier on the low end, not great. China is obviously problematic where the younger generations are smaller. The United States,
I don't believe in China's capacity to challenge us in the longer term because of that pyramid.
Maybe they don't need to challenge us in the longer term, Ilya. Maybe they just need to challenge us right now.
Well, I mean, they're certainly intent on it.
So it is, a country like Mexico, for example, has being a Central American country with a younger base, you could see how younger population, and it's one of those things that helps keep our labor market afloat, that we have a next door neighbor with a lot of young workers.
You'd think we are so much better positioned than Europe because we have Mexico with whom we have a trade agreement where the population isn't in a demographic crisis, that have more years of education per worker than does China, where the cost of labor is a fraction of what it is in China, which sits on our border. You'd think we'd be doing everything we can to leverage this advantage. Instead, we are cracking down on immigration across the southern border.
We do see a second highest close of the year here today for the Mexican ETF, for what it's worth. So it's not exactly like it's been a big overhang. Canada, on the other hand, not a problem, weaker currency. This is something that popped up on my screen today. I couldn't help but notice the volatility in the Canadian dollar shot through the roof here. IVRs of 100. Again, in the currency space, you're seeing relatively elevated IVRs compared to the rest of the market. Pound, Aussie, both in the 30s, Canadian dollar north of 100, euro over 30, yen over 20. Dylan, how do you look at something like a Canadian economy? If the US is muddling through and we're getting these faster growth rates and it's better than expected, right? Shouldn't Canada have a bit more upswing to it as well? Because it means that our demand engine isn't falling apart? Or is this just a new world? We can't think of the world in terms prior to April 2nd, 2025, and the US may be muddling forward, but the Canadian economy could be screwed. So forget prior relationships.
Yeah, I mean, few things. One, I tend to think of the Canadian economy as utterly irrelevant.
Fair enough.
I mean, I can't think of a less relevant. I mean, it's relevant to Canadians. To the world, who cares? One. Two, if you do care, it's a petrostate. It's no different than Russia or Norway or Venezuela. And so as far as I'm concerned, the Canadian dollar trades much more as a derivative of oil as it does to any economic activity. And three, I can't think of a country that's more damaged by Trump's activity than Canada, because I don't think there's a country that, because the economy is relatively small and extremely dependent on trade with the United States. Which leaves me to have a fairly negative view of I think that Trump is against trade with Canada, which couldn't be more stupid in my opinion. But I do believe that the Trump administration is against trade. I believe the Trump administration is, probably to Ilya's point with Mexico, I actually think the Trump administration is more aligned with trade with it's more hostile to immigration with Mexico because of fundamental American racism, but it is more interested, America is more vested in trade with Mexico because of the auto manufacturing business, which is a core American industry that's entirely, has a massive investment in Mexico. Now, I know there's a lot of auto manufacturing also across the bridge in Detroit, so that's not nothing.
Well, in Canada, it's now.
But that's what I'm saying. That's what I'm saying, that the Canadian piece is not nothing because of the across the bridge in Detroit. But none of that reveals any insight on the Canadian dollar. I have no idea why the volatility expanded in the Canadian dollar today.
To your point, we've seen the Canadian economy pull from the U.S. economy last year in the wrong direction, largely because what's been powering the U.S. economy has been the service sector. The goods sector has been kind of dead. Really, there's been nothing stirring there until these tariffs. But overwhelmingly, the strength of the U.S. economy and the sort of standout strength, really, because Europe has been on standstill since mid-year last year. China has been at near standstill since mid-year last year and continues to be there. Ditto for Europe. The U.S. had a bit of a dip at the start of this year with this tariff rollout. It's now apparently reaccelerating. Chris, I know you'll like this. This is a seasonality thing. Brent Connolly of well-deserved fame pointed out this morning that the economic surprise index actually has a degree of seasonality, and that September is a good month for U.S. economic data seasonally, going back the past 10 years, which is interesting. But if the U.S. economy is reaccelerating, it is reaccelerating in service demand. And services demand is primarily something that's met with domestic firms. The reason Canada is sort of historically so sensitive to what's going on in the U.S. is, of course, 80% of everything Canada exports, including those linkages in the auto industry, Dylan, comes mainly to the U.S. So if the U.S. is having an issue, Canada is going to see it because of a drop-off in demand, et cetera, et cetera. Well, the problem is U.S. hasn't demanded a lot of goods recently. It's been mainly services, and services are mainly sold at home by domestic firms. And so Canada has had a tough time in their economy despite a booming U.S. basically since the middle of last year. So I'm not sure how much of a window the Canadian dollar is here into what's going on into the U.S. The two economies have kind of gone their separate ways a little.
Do you have any insight into the expanded currency volatility period, not just in the dollar? I mean,
yeah, I think we're getting to a place where the dollar has started to sniff out something, because if we look at what's going on, again, since the beginning of July, the outlook on Fed policy has only become more dovish, but the dollar is holding. And I think what might be going on here is the market's getting ready for this September FOMC. The currency market is the spot FX market, the largest thing, the largest marketplace in the known universe. Much larger, for example.
Suggesting that this is a prelude to a dollar move higher?
Yes. I think that what the market is starting to sniff out here, perhaps, is that the dollar is done falling, and that perhaps the biggest rug pull of all here isn't going to be that the Fed does or doesn't cut rates in September. It's that they don't endorse this dovish expanse that the markets have baked in. And that gives you a dollar rally. It disappoints the stock market, where everything for this year has long since been baked in. And so you have a kind of maximum pain for everyone involved. Those betting on a downfall of the U.S. economy, wrong. Those betting on the U.S. getting eclipsed by a Russia-China-led challenger, wrong. Everybody is wrong. And the stock market is wrong, and the currency market is wrong, and everyone is wrong. The market loves things like this. We saw this with the September FOMC meeting last year, where the question wasn't, will the Fed be dovish enough, or will they be more hawkish than the markets want? What ended up happening was they were more dovish than anybody dared hope, and it threw everyone for a loop all at the same time. I think we're setting up for something like this, maybe, where the Fed isn't doing the thing. It's doing it, but it's doing it and forecasting it differently than the markets want it. And it's because the economy is stronger. And that's what takes markets down.
Well, it is usually a good month for the U.S. dollar.
How about this short S&P long dollar through the Fed?
I'm there.
No thanks.
I am there. I am so there.
Have fun. How about just long dollar and long stocks? Why can't we all just get along here? Yeah, well, the S&P
I mean,
500.
I'm long some stocks.
Yeah,
just
but
not the U.S. indexes.
you're the Combs to my Hannity in this
Yes.
thing.
Yes.
Right.
Yes.
So 64.61 here. Dylan, I saw that the White House released their preliminary list of 68 occupations that would qualify for the new deduction moving forward. I see under entertainment and events, there's digital content creators. How creative should our accountants be this next year? We're digital content creators.
Yes.
Yeah. Something to think about. I'd like to hear what the chat has to say. Maybe we can lobby to get all paid in tips now moving forward. That'd be fun. Okay, so we have our NASDAQ here as our leader. It's up 0.8% after hours. It's in the midpoint of basically a trading range it's been in for the past several weeks, going back to the start of July. Where does that leave us ahead of non-farm payrolls? It's really tough to be directional right here. You could make a case either way. If we keep to this 25 basis point rate cut landing come Friday, I think that's probably the best outcome for the market. You get to 50, you spook everyone that the Fed's cutting for the wrong reasons. We want the Fed to be able to convince themselves that they're cutting for maintenance reasons still. And maybe they are, right? If GDP is at 3% and there are signs of economic reacceleration, we saw PCE last week coming only at 0.3%, which is much lower than what would have been imputed from CPI and PPI. Maybe they can look through the inflation bump, and they can focus on that labor market weakness that's starting to set in. There's a few charts that I've shared today on Twitter, and I put this up on Futures Power Hour earlier to such an effect, but it's worth doing again here now. But in Tursten Slack over at Apollo Global published this in terms of downside risk to non-farm payrolls over the coming months. You could see when the U of Michigan expected change in unemployment rate on the right-hand side versus the monthly change in non-farm payrolls. We're heading deeper into negative territory. And then looking at the NFIB surveys, single most important problem being poor sales. That's rising. We've seen it tend to be a bit of a leading indicator in years past going into other cycles. So the labor market looks like it's still going to be soft moving forward. And I think that's what the bond market sniffed out today, because today was a really, really, really good day for the bond market. No matter how you slice it, ZB, ZN.
Huge day.
ZB's up a full point right now. Is this the safer trade going into Friday, guys? Dylan, if you had to be long bonds or stocks into the jobs report on Friday, where do you feel more comfortable putting your incremental dollar right now?
Stocks.
Why is that?
Because I think that stocks are dominated by the AI supernova, and I think the bond is generally more sort of dominated by the granularity of the economic data. So I think that the tea leaf reading of the jobs number represents more risk for the bond and the dollar than it does for the stock market, which I believe the stock market is drunk as a skunk on AI juice. And I don't think it's going to wear off until that Fed meeting. And then I think the soonest that the stock market wears off is with the Fed meeting. They may sober up and realize that the Fed's cutting rates for the wrong reasons, as you would say. But I also just don't think, I think that Trump has done a reasonably, the jobs number has always been a little bit of a wild monkey.
It's a squirrely number.
And it's always been heavily revised, when you go back. And Trump has exploited that by sort of amplifying skepticism around the number. And so I think that also that the relevance of the jobs number is that if it's a bad jobs number, that Trump will write it off as fake news. If it's a good jobs number, it'll help the stock market, and it won't be such a good jobs number that the Fed's not going to cut rates because the labor market's too hot. But it could affect the expectations for future rate cuts, to my friend in San Francisco's point, which I think is more relevant to the bond. How's that for a wraparound answer?
Yeah, it's just so funny. It's like, okay, you want a rate cut? Here's the data that proves that you need a rate cut. And it's like, nah, that data's fake.
Yeah.
It's like, what guy?
Yeah, what?
This is the guy that told you the tariffs brought in more money than the total aggregate trading value of every single good and service in the entire U.S. economy.
That is true. We've apparently made $8 trillion so far because of the tariffs. Good
but
on
our
us.
aggregate trading is only 7 trillion. Sorry.
So Ilya, what's
just think what that means. We have hiked taxes on U.S. taxpayers to the tune of $8 trillion in a Republican administration. What?
Yeah, don't think too hard about it, Ilya. Stocks or bonds for
That's my
Friday's-
problem. See, it's the thinking. I got to stop doing that.
How long do I've been saying this for weeks? The thinking is a huge issue. You really need to think about not
so
thinking.
easzy, Ilya. Don't
I
think.
just can't help myself. I think the audience needs to finance a lobotomy.
You just said I think. You did it again. You just said it.
I can't help it. I can't help it.
Those 2 words. Every time there's a problem, it starts with those 2 words.
Your
It's
audience,
terminal.
help us finance like a little shock collar for Ilya every time he says I think. So we can actually pass it around. Someone in the audience can buzz it, right? Or they can send a word to the chat.
Now
It's like, no,
there's a
stop
good
thinking.
gimmick.
Yeah, it's like a dunk tank for tasty. Oh God, this is a terrible idea. We have to bring this to Beth.
This is how we're gonna get the digital content creator tax credit.
Yeah. Yeah. People can bid up. Who wants to put a shot collar on Tony and buzz him in the chat? So, okay, ZN and ZB here both have really stupendous days. And ZN, if at least we go to the continuous contract, it's kind of pressing up at the top side of a range here. It feels like this is really squeezing in now. We're riding up that 1 month. It really just wants to hold the 1 month. So earlier today, my particular bit of rigmarole with my bond position, I'm still trying to get out of my iron condor at 23 days, roll out to 51. But with ZN, I did ultimately move out into a long call spread as opposed to being in a short iron condor here, because this thing looks like it wants to pop. And rate cuts are coming. And if the worst thing that happens is that the Fed tells us that they can't cut because the economy is too strong, not that inflation's too hot, the long end of the curve probably doesn't blow out. Right,
No.
this context is ever changing. I'm going to have
No.
a totally different feeling on this tomorrow, but then the long end doesn't blow out.
Right.
And like that to me is the most probabilistic outcome as of what we know today. So that's my pure adjustment there. Dylan, silver and gold have been really kind to folks the past few days. I know you're not much of a gold trader. You said that you don't seem to wrap your head around it, which is fine.
But now that the whole with the AI murder drones, I'm coming around.
Okay, you got some time. Tell me why is gold the preferred hedge with AI murder drones and not the not Bitcoin?
Because the great hacking, anything that is non-physical will become worthless in the great hacking. Once quantum and AI gets done with the great hacking, all the only physical assets will become the only store of value.
So people are going to walk around with their gold bars. They're going to shave off little
I
bits
don't
at the
believe
grocery
that
store.
that's going to happen, but I believe that sentiment around it will continue to propel buying of gold in fear that one day it could happen. So I'm not here to say that, oh, yes, people are going to be walking on the streets with gold bars fighting off murder drones. I'm saying as people become increasingly skeptical, anxious, and worked up, yippee, as some people have said, just about the overall digital risks, that it's all gold positive. And not to mention the crypto, people don't, people rightly, I think, should question crypto's value. I think as the Trump family makes it obvious that it's a giant scam, as they use the presidency to pull in $5 billion, crypto becomes a less credible alternative to fiat currency. At the same time, fiat currency has all sorts of issues. And so I think all of it sort of comes back to gold as a store of value that is transnational and post-digital apocalypse.
I'm actually with Dylan on this to the point where, Chris, we talked with Tom on First Call about you can now short Bitcoin because IBIT lets you have options on it. And so you can actually structure an attractive risk reward position where you don't risk that much money. And you can have incredible risk reward. And I was actually able to structure a put vertical in IBIT going out 59 days. That's 4.5 times to 1 risk reward, risking about $200 for every $900 in profit potential. So I have that on now because if you look at it just ticker agnostic, Bitcoin looks like it's broken a range and is starting to come in. And obviously, we talked yesterday. I've gotten myself into a long position in gold on this breakout as of yesterday. It continues to work in spades, obviously surging. So, to Dylan's point, I'm effectively in a kind of pairs trade here: long gold, short Bitcoin.
Well, we see here gold's up at 36, now 21 after hours. Silver prices, they did top 42 earlier today to pull back in. They're up by 0.5% right now. I cut out my gold positions yesterday, guys, just because 3 DTE, and to me, this is a little uncomfortable looking how far gold is from just its 1 month, it's 50. When we've seen this in the past, it hasn't lasted that long. Post-election, post-liberation day is a different story, but even so, you kind of get into this territory where at the highs, you're $300 north, talking about like, and when you're in that 7 to 10% range above your 1 month moving average, gold has been overcooked despite whatever the backdrop has been. We're getting into that zone right now. Just thinking about playing this, call it responsibly. Maybe it's MGC for folks who are just riding the momentum wave, but I would watch this 1 week moving average here. We close above it on August 22nd. And since then it's been the rails that have guided gold prices higher. And really for the first time during this rally, we don't touch it today, kind of showing how this thing is really getting stretched. But at 35.50, being short put spreads against that level, 3,500, 35.50, it is a 2-to-1 risk to reward, a little bit better than that. It's a big contract, a big trade, so maybe people want to do it with GLD. As for me, I prefer leaning long silver still, just because there's still a bunch of time in that contract, 55. This is also getting long in the tooth. So fully anticipating that there may be a pullback, but as long as we hold the former highs around 40, 25, 40 and a half, no reason not to stay bullish, especially if Dylan's murder bots are coming.
Ain't mine.
Dylan, you got to get out of here. Do you want to have a final thought?
Hopefully the murder bots don't hunt me down on the way to the airport.
Well, if they get you at the airport, that's okay, because at least you've made it to your destination. But before then would just be such an inconvenience.
At least I'd like to get a cheeseburger in before they take me out. I do like a good burger at the airport.
That's nice. Noted. Dylan's final meal before the murder bots come, a cheeseburger.
And
Dylan,
I'll be in Montreal. So
have a safe flight.
I'll see you tomorrow. All right, bye, guys. Thank you.
Ilya, you and I can go wherever we want to go for the rest of this. As far as I'm concerned, the market today was not anything spectacular, interesting, noteworthy. It's just the second day back after vacation. Usually the first 2 or 3 days, the influx of trading volumes again. And it was a healthy volume day, 1.38 million in the S&P 500. What's the plan for the second half of this week? How do we approach this with volatility staying low in equities, VIX coming back in here the past few sessions? Do you just keep playing sideways chop until non-farm payrolls and then wait for the directional move then?
Well, I think you have sort of ways you can approach it depending on your time frame, and my time frame is almost never in something that I count in terms of days. For me, a trade that's good typically lasts a few weeks. A trade that's wrong typically is cut within a week or two. So there's about double the holding period. I'll hold a trade that works on average between 3 and 5 weeks, something like that. That's sort of in the realm of the normal. So for me, I think now in the second half of the week, you're into data that actually has consequence. So tomorrow, we're going to get the ISM service sector index. That's a really important set of numbers. If not for any other reason than the price component there, and you and I have talked about this extensively, tends to lead CPI and PCE by about 2 to 3 months, give or take. And what it's been signaling is that the PCE and the CPI numbers are going to blow out, because we're just coming up on that period here where the ISM price component has already told us with this 2-3 month lead that we're about to start seeing hot numbers. And either this thing pulls back or it doesn't. Now, the manufacturing side has been pulling back. This has resisted. Service sector is still hot. The expectation is that we're going to get a reacceleration. If the thing is hot, people are going to start looking at this, to our point about U.S. economic data seeming to start to surprise higher over the past 2-3 weeks or so, with some conviction that markets are not going to wait. They're going to look at this and go, oh man, we're not going to get this validation in the summary of economic projections, are we? And already next week is the Fed's blackout. There's nothing. Nobody's going to say anything next week. So it's the ISM number and it's the jobs number on Friday this week. If the ISM number is hot, the expectations for Friday's NFP and the level of speculative fervor around, wait a second, this isn't about September. September is a given. We know that. It's what's next. It's what's next year. And the markets are significantly out on a ledge relative to what the Fed is saying for these ISM numbers to come in hot and for the jobs number to come in hot. So if
are you
that's
arguing
where
that
this
good news is bad news this week?
Yes. Yeah, I think so. I think so.
What kind of news is good news? Because I also could make the argument, I think that bad news is bad news still.
Sure.
Right? Like, isn't there a sweet spot? Maybe this is a little asymmetric, but
Yes.
hot jobs number, odds for September come in, December's lobbed, or December cuts shift to December, October's eliminated. Basically,
Yeah, I mean,
we're at 51% for October. So you get a hot jobs number, September odds come in, but you're still going to get it unless it's a really hot inflation report. October goes away, market locks in December as the second cut. If it's a weak number, you get the October cut locked in, you get a third cut in December locked in. All of a sudden, the Fed's cutting for bad reasons.
Yeah.
I just think the bad NFP scenario seems to be the one that carries more risk for the market right now.
I think you've got to thread the needle really finely here.
It leans us away from maintenance cuts and more towards the recession cuts.
Yeah. No, I think you're right. I think the trouble with this NFP report, and for that matter, the ISM report, is you don't want anything that isn't with some very modest wiggle room bang on expectations. And really, this is what we've seen. I mean, consider what's been happening. We haven't gone anywhere in August. We get the CPI report, markets go, oh, this is good. Nothing is disturbed. That gets the markets one day. And then stasis. Then you get Jackson Hole. Oh, this is good. One day. Stasis. NVIDIA. Oh, this is good. This is fine. We can survive this. This is not the worst. This is better than it could have been. It's not great. It's the weakest upside surprise in 2 years, but this is okay. We can stomach this. One day.
It's interesting.
I read one day. This market cannot but survive event risk at this point. Never mind thrive on it.
How many rate cuts did we have last year? 50 in September, November, December,
100 basis points.
100 so far. Given where the Fed's going right now, we probably get at least 50 more cuts, which means during this cutting
the markets
cycle.
and the Fed agree on this.
Well, but that means we're going to have 150 basis points of cuts cumulatively since last September.
Yeah.
Historically speaking, when you have 150 basis points of cuts, once you pass that threshold, do small caps start to reliably outperform their mega cap counterparts. So the Russell has perked up here and is still holding up right now. And I've left it hanging here on the screen because while it doesn't get the attention of NQ or ES, rightfully so, it also has a pretty decent looking setup still.
Yeah.
Where we just bounced off of the most recent swing high yesterday and today with an inside bar. So it's decline, doji, signaling that this little correction may be over. The small caps have been unloved for such a long time right? They haven't done anything for really years. We could go and look at the Russell continuous contract, and we really got to go to the weekly. And let's go back 10 years. I mean, we haven't even cleared out the levels that we were at in 2021. This has been a multi-year trading range down here.
Right.
So what if this is the window where we finally get that Russell outperformance?
It could be.
I think the timing of this really matters. If the economy, if we keep looking at Atlanta Fed GDP, and 2 weeks from now, it's the Fed meeting, but 2 weeks from now, it's 3% and the Fed cuts. And then we go into the middle of October, and that's still looking at 3% before we get the GDP report, right? And then GDP comes in at 3%. There's still going to be the tailwind effect of the inflation that's coming through the pipeline.
Sure.
But if the labor market's cooling and aggregate demand is dissipating and it's enough to offset the tariff increase economy-wide, then the Fed is cutting and helping reduce the labor market, and you can kind of keep the music going, which
I think that's what the market is hoping.
We managed to do that in 2022, didn't we? I know inflation surged, but the economy didn't go into recession.
No, because I think, and this was really key in the middle of 2021. In fact, the June, I mean, you can go and read the policy statement if you're not familiar. Go read what the Fed said in June 2021, because the Fed basically came out and said, okay, the inflation is not a transitory thing. We need to start gearing up to hike. And for the next 6 months, they talked the markets into a new paradigm. They gave a very telling speech at Jackson Hole. They started walking the markets through what this looks like. And then they gave them the forecast in December of that year that showed them where the Fed would go. And then come March, they started to hike. Heavy-handed. But they walked the markets through it for 6 months. So they had the benefit of at least saying, right, this is what to expect. And so the economy didn't fall off because expectations were well managed. Kudos to the Fed. We're not in that kind of an environment here, if only because the White House is a total wild card. And what this might look like as a consequence of how these court cases go at the Supreme Court could be a whole other ball of wax completely. If we consider the markets have spent from April to now coming to terms with what the tariff regime is and going, okay, it's not the worst it could be. Okay, it's not going to be the worst of all tariffs. The world is not fighting it. They're trying to cobble together deals because this is still the largest consumer market in the world, and even China can't front on that. They need this demand also. So, okay, we're going to figure this out. The administration is not immune to market discipline. They're not going to do something completely idiotic and destroy the U.S.-based bedrock of the global financial system, or at least not intentionally, as they appeared like they wanted to do. Imagine what happens if all of a sudden the entire consensus is tossed out the window. Because suddenly the tariffs don't stick, the Supreme Court doesn't bless them, and then the administration has to pay back something to the tune of $200 billion back to U.S. corporates.
$8 trillion.
Well,
whatever.
Yeah. I guess the administration can spin it as a tax cut.
I
don't want to give anybody any ideas. Forget I said that.
This New York State public education, private education in college at Lafayette, like CFA charter. Obviously, I don't know math that well.
Yeah,
So my bad,
billion, 8 trillion. Close enough.
Just
rounding error.
Dr. Evil math. With that, we're out of time here on Overtime. We'll be back tomorrow, same time, same place, every Monday through Thursday, 4 p.m. Eastern, 3 Central, right after last call. So for Ilya Spivak and a departed Dylan Radigan, I've been Chris Vecchio.
Kind of departed.
We'll see everyone tomorrow, same time. Until then, though, take a brief break, get some water, some coffee, and then Ilya's back with you. Tasty at night. Macro Money up next.
See you there, everybody.
The market doesn't stop. So why should you? Diversify your portfolio with stocks, options, futures, crypto, and more from Tasty Trade. Focus on the markets that matter to you. See the odds before you trade using curve analysis, IV rank, and more tools. Get industry insights that help you find your next trade right where you need it. Tasty Trade. Download today.
Class is in session. Dr. Jim Schultz is bringing the heat to Options Crash Course Live. This 90-minute show features Dr. Jim in his professional prime. All of the gimmies, none of the gotchas. Come early and grab a drink with Dr. Jim before class and stay for Q&A. The event is free, but space is limited. Register today at tastylive.com/events. It's not a lecture, it's a lifestyle.
The beauty of Thinkorswim was that we were different.
From the name to the front end technology was clearly what we wanted as traders. Second time around, I think we did a better job. Yes, we are known for our ability to support complex derivatives traders, but we also have the tools for somebody who's brand new who wants to come in on the first floor and work their way up to the top of the building. The amount of time I spend interacting with our customers via email or anything else is pretty much my entire life.
To be so powerful and so valuable, and then to be that approachable, just amazing.
Where else are you going to be able to email a CEO, get response back?
But you know what? Before he even knew who I was just some idiot trying to learn how to trade. And he still would email and help me learn and everything like that.
Some people say it's nuts, some people say it's insane. You know, that's what I do.
Traders, start your platform. Tom Sosnoff and Tony Batista are hitting the road for their first ever live trading event, At Work by 11. It's unprecedented, unpredictable, and unlike any other financial event. Watch these masters make real trades in real time. Doors open at 8, the action starts at 9, and we'll have you back at work by 11. Sign up today at tastylive.com/events.
What's a macro risk right now that people aren't talking about enough?
Complacency is one. There's a lot of bullishness around. The street is very complacent. There's very little cash on the sidelines. And I think there's just, in general, the regulatory environment is too good, so people become overconfident.
I still think the geopolitical thing is very, very interesting. Frankly, I've had a tough time kind of parsing out the headlines in the news lately. I guess I would say like this ongoing discussion of just different conflicts that are going on and how it's pushing and pulling different asset classes. That's a super diplomatic answer. I'm not unaware of that. I think it's really important to kind of be mindful of your positions when there is so much talk and uncertainty going on and making sure that you're always controlling your size.
I mean, the dollar's depreciated over 10% against the euro and some other major currencies. I don't see how that doesn't start to play into some companies' earnings and their fiscal reports.
Ready to take your trading skills to the next level? Dive into the world of stocks, options, and futures with Tasty Trade courses. Whether you're a beginner or more advanced trader, our courses can empower you with the knowledge to succeed. Watch as our team in Chicago shows you how to use the Tasty Trade platform and go over the basics of trading. Perhaps you'll learn about a new strategy or a potential product for your portfolio. To find our courses, go to the Manage section of our web platform or head to courses.tastytrade.com. Start taking control of your financial future. Visit our courses today.
So I started trading in the equities market when I was 18. Real basic ETFs, mutual funds. I didn't discover options and really Tasty Live until about 2012. It made sense to me from a risk perspective. And so I started trading and never really have looked back. The people you see that's who they are. They're trying to be as open and clear as they can with the trades that they're putting on. Teaching a methodology, like teaching the logic behind things. It is tried, true, and tested. They back it up with why a position did what it did. You know, sometimes the market wins and sometimes you have a 90% winner and you don't know, why don't I do this every day, right? This is easy. But you kind of have to reset that and just go, okay, close the trade and move on to the next one, which is really what Tasty's about.
It stands still for the stock market. But we do have some spicy economic data in the offing, just 24 hours away, even less even. And perhaps we can finally get some motion this week. That's what we're going to talk about here on Macro Money. This is Ilya Spivak, head of Global Macro here at Tasty Live. And what we're going to do here is first take a look at what these markets have done today, how that fits within what they might be looking to do over the course of the rest of the week, and really how it fits with where they've gone already. And the operative question here is, do the markets actually want a strong U.S. economy? Because we are going to get some economic data here that is going to give us a view on the economy. And of course, we're looking for rate cuts this month. So ostensibly, the hope is that we are going to get an economy that's soft, but not too weak. And the evidence, were it to present itself to the contrary, either this way or that, could very well upend market consensus and force a repricing in a way that wouldn't be so great, perhaps. And we're going to talk here about why that is and what this could mean across a range of assets, from stocks to bonds to currencies, and of course to high-flying gold. So let's take a look here first and foremost at how the markets did today. This is not perhaps the most exhaustive sort of readout, because I took the screenshot while futures were still adjusting for the daily close, but this gives you a sense of where we went today. A little bit of an increase for the S&P 500, 0.53%, a slightly larger one for the NASDAQ, 0.75% there. Yields down again. This time it's the long end that sees the biggest decline, almost a percent off there. The front end off by about half a percent. Crude oil smashed back down toward its range bottom. Nothing really doing there, but we did have an attempt at something of a breakout earlier, and that has been summarily aborted. Crude oil down 2.5% here. Gold continues to march higher, still pushing to new record highs, up 0.8%. Euro and the yen managed to claw back some lost ground against the dollar, albeit very, very modestly so, up about 0.2% apiece. And Bitcoin manages a slight bounce, up 1.2%. Let's put this in the context of how the markets have behaved this week, and suddenly these moves look like an afterthought at best. The S&P 500 is net down a little bit this week. NASDAQ is flat. Rates haven't really gone anywhere. Neither has crude. The dollar is a bit stronger on the week, despite this move over the past 24 hours that's seen those gains pared back a little bit. On the whole, the dollar is up almost 0.4% against the euro, almost 0.8% against the yen. The standouts are, of course, gold and Bitcoin. And when we compare this to where the markets left us last week, we can see that for gold, indeed, there is momentum. Last week, it was up 2.9%. So far this week, it's up another 3%. But Bitcoin being up 3.8% is hardly encouraging, considering last week it slumped almost 7%. So it's recovered a bit of lost ground, but it is still very much in the doldrums here last week into this week. So that's where we stand. The markets are basically idling in place here after last week. And so the real question seems to be, number one, what is gold all about here? And number two, what is going to get these markets out of bed? And the second question first here, as it were, the next several days finally give us some macro event risk to work with. And the next inflection point here comes at us by way of the service sector PMI from the Institute of Supply Management. Now, we already had the manufacturing number earlier this week. It came in at 48.7, a little bit worse than the 49 expected. As ever, for PMIs, this is a diffusion index. So 50 is neutral, above 50 is positive growth, below 50 is negative contraction. The further you go above 50, the faster the growth. The further you go below 50, the faster the contraction. So you can see here that we expected for the manufacturing sector to be in contraction territory at 49. We got it at 48.7, so it's contracted a little bit faster than anticipated. But for the most part, not a big difference. As we can see, as a matter of fact, for July, both the service sector and the manufacturing index hugging 50 here. Of course, manufacturing on the low side, the service sector almost exactly at the line, gave us an economy that was at best approaching standstill. Well, the expectation for this number in August's report is that we're going to get a spirited recovery back up to 51. That's certainly nothing to sneeze at in context here. That would actually be quite the significant recovery. In historical terms, up to 51 would be the strongest since April. So a spirited rebound in the forecast, and of course, services is a much larger component of the overall U.S. economy. So were we to get this bounce, you might perhaps conclude, well, maybe the U.S. economy is reaccelerating a little bit here. Now, as it happens, we already got some numbers out of S&P Global that suggest that indeed the U.S. economy has been reaccelerating for quite some time. We can see the composite index here that takes in both services and manufacturing has been powering higher for a few months here in this version of the data. Moreover, we can see that the situation has been mainly powered by services. In August, as it happens, we didn't get a strong lead from services. It kind of idled, but we did get a potent increase on the manufacturing side. Strong rebound here. And we already don't have that in this ISM number. So perhaps we are looking at something more constrained. Nevertheless, if we look at the way that U.S. economic data has performed relative to expectations recently, we increasingly look at this very strong improvement in this City Economic Surprise Index, showing us that indeed U.S. economic data has increasingly, especially over the past 2.5 weeks, outperformed relative to baseline forecasts. Now, this is, of course, especially interesting because this doesn't speak to the data being good or bad. It speaks to, in absolute terms, it speaks to the data being better or worse than expected. And when you're above zero here, as we've been really since the beginning of July, we've seen U.S. economic data tending to register better than expected and increasingly vertical in that direction over the past 2 weeks. This basically means that economists' models of the U.S. economy, from whence expectations come, have been entirely too pessimistic relative to realized outcomes, and that actually the economy looks stronger looking at this data than anticipated. Now, if we look at the Atlanta Fed's GDP Now model, importantly, this is a nowcast, not a forecast. So when people bang their table and go, this number was wrong, well, the question is when. It's a running tally, not a single forecast. And what we can see from this running tally is that the data going into the model since late July and until about the middle of August was basically steady, a little bit better than consensus forecast. We have a range here from 0 to 2% for the annualized growth rate in the third quarter, and it'll be a long time yet before we actually get the third quarter numbers. But what we see is that while this was relatively steady here, again, echoing what we've just seen in the economic surprise index, the tone of the data over the past 2-3 weeks has been aggressively more positive, and that's pushed this model higher. And so now, whereas the top end of expectations in the markets are for growth in the third quarter of just under 2%, this model says it's closer to 3%. So although we don't have a perfect matchup here with the mix, services versus manufacturing, S&P Global, which is what this is, back to ISM, we certainly get the sense that the economy is improving, and the general tone of economic data seems to echo as much. Today's soggy JOLTS data notwithstanding. That data, of course, as stale as July. So perhaps it doesn't really matter much anymore. In fact, even within that soggy ISM report for the manufacturing sector, we can see here the 5th consecutive month of contraction here. We can see the pace of contraction has in fact eased from July into August. Moreover, this decline in the pricing component, this decline in basically inflation input costs, of course, very much linked to the tariff conversation, that has bid up new orders. And this does, in fact, suggest that we have some positive cues here emerging under the surface, despite the weakness of the headline number. And of course, this would be consistent with the PPI, the Producer Price Index data that we saw most recently, suggesting that wholesalers are, after a period of some months where they were eating the tariff costs and trying to insulate consumers, hoping the tariffs would somehow go away and maybe they didn't need to destroy demand by passing on these higher costs. Well, they've started to pass them on because apparently they've concluded that the tariffs aren't in fact going away. In the second quarter, as a matter of fact, inventories were spent down. Those inventories that were accumulated in the front running of the tariffs in the first quarter. Imports basically stopped because companies did not want to go out and buy things at higher costs if they were going to eat those costs. But now, in the third quarter, it looks like the pass-through from inflation is occurring. Companies have stopped attempting to shield consumers. Now they're expanding their margins back out to pass on those tariff costs downwind and to the end of the supply chain, the retail end of the supply chain. And perhaps on that basis, they're starting to buy inventory again because they're no longer in a place where they're saying, well, we're not going to buy expensive inventory if we can't charge expensive prices from consumers. Now they're saying, well, if we are going to pass on these costs, let's restock. And so there seems to be a kind of parallel situation here where, of course, price growth is still very elevated, but not quite so much as it was. New orders are picking up in perfect sync here. You can see here's the top in prices, here's the bottoming in new orders. And so perhaps we are, in fact, seeing a U.S. economy reaccelerate. And this is where things start to get a little bit hairy for the markets. Now, you'd think a positive surprise on U.S. growth, a reacceleration of the U.S. economy, should be something that the stock market celebrates. Well, maybe so, but that would be as misguided of an assumption as saying every rate cut takes down a currency. And those of you that are familiar with what happens with an earnings report or a well-telegraphed policy announcement would surely have had the experience of saying, wait a minute, why is the stock falling when earnings beat on the upside? Just take a look at NVIDIA last week. Why is a given currency going up or down? Let's say it's going down, but the central bank raised rates. Well, how does that make sense? Well, it's because the markets are forward-looking, and they don't so much care about what is once it's been discounted in the price. They care about what will be. September's rate cut, for what it's worth, has only become more of a certainty. Fed funds futures now have it at 95.4% chance. And there's not a fuzzy conversation about maybe it'll be a 50 basis point cut or some such thing. No. Speculation is very clearly aligned on one 25 basis point cut when the Fed convenes on the 17th. The likelihood that rates stay unchanged has dropped to less than 5%. The markets are convinced. Where things get hairier is when we look at the overall outlook. We can see the markets are very well anchored for this year. They've been stuck at 50 basis points, basically going back to May. We've seen a little bit of a wiggle higher. We've seen a little bit of a wiggle lower. But the baseline consensus here, the baseline range, still calls for 50 basis points. And the Fed is really running out of calendar to deliver them. There are but so many ways that the central bank can give you 50 basis points over the course of 3 meetings. We are very clearly priced for one cut in September. That leaves October and December. On one of those meetings, the Fed's going to give us a second cut, the markets would say, and the Fed would concur. Take a look at what we have here in June's summary of economic projections, and we can see the baseline rate is 4.4. That's the midpoint between the current edges of the range. We can see here's the current range, 4.25 to 4.5. The midpoint is 4.38, so 4.4. From 4.4 down to 3.9, that's 50 basis points in cuts. In fact, the Fed has called for this going all the way back to December of last year. So the markets and the Fed are generally in alignment on what is happening in 2025. The disparity is here. The markets have baked in 78 basis points. That's at minimum 3 rate cuts and a slight chance for a fourth, albeit a very small chance. Nevertheless, the markets are tilting in that direction. In fact, they're a hair from where they were at the dovish extreme back when everything collectively freaked out in early April around Liberation Day. The Fed is nowhere near there. Last time they gave us this update in June, they had 25 basis points in the outlook for next year. Now, let's say we get a hotter ISM number. Let's say that this gets the markets thinking, wait a minute, if the U.S. economy is reaccelerating, are we wrong to have been betting that the Fed is going to do all this easing? Sure, we're going to get the 50 basis points this year. We know that. We've been knowing that. That's not controversial. It's in the price. There's not much of a rally to be had in that conclusion. But what happens if all of the easing that was priced in for next year actually starts to look wrong, and the Fed starts looking right in its loud prognosticating of worries about inflation surpassing worries about the labor market, which they've acknowledged seems to be showing some signs of wear and tear, but which they have not elevated to be more important than inflation expectations. And so you look at the way the S&P 500 has performed here, and you can see that, okay, here was the beginning of the year. This is where the tariffs start to roll out, and the markets go, oh my God, this is hitting business confidence. It's hitting consumer confidence. This is going to be a growth scare. And so stocks go down, and the expectations for policy get more dovish. In April, you get the sense, oh, okay, so the administration is not firmly committed to cut off our nose to spite our face. They are, in fact, open to some degree of market discipline. When stocks and bonds and the dollar fall in tandem, the administration backs off and says, okay, 90-day pause on tariffs. Let's not go crazy. And so there is obviously a level of relief here in the markets. And in fact, that relief even lasts for a bit on policy expectations. But then it is clearly aborted. So once you get to about here, where the markets have basically shaved off all of the spook around the tariffs, you've also exhausted the level of improvement on policy expectations. And from basically here onward, stocks continue to sail higher as the outlook for policy gets more and more dovish. This certainly starts to explain why we are seeing as violent of a rally as we've seen, when in fact the situation on tariffs, certainly beyond this point, hasn't much improved. The situation on growth hasn't much improved until very recently, and again, only in the survey data. We'll see how it goes from here. But certainly, the expansive stock of easing that's built up here, note, this is where the standstill begins for this year. This is where the markets go, okay, the economy is anchored around the Fed outlook this year. It's going to be 50 basis points. That's it. All of the action has been here since May. But if this is wrong, well, then perhaps this is wrong also. And so a positive ISM number that gets the markets thinking the Fed is going to leave them hanging on these rate cuts for next year when they update their outlook in 2 weeks' time, that may very well get stock markets heading in the wrong direction, and for an economy that's stronger, not weaker than expected. The dollar may, in fact, be starting to sniff this out. We can see here, for all the dovish progression that we've seen really over the past 2 months, July and August, the dollar has not fallen. It was very clearly falling as the outlook got more dovish in the first half of the year, and even extended as much into this last leg of baking out for next year. But from the beginning of July, the dollar has bottomed and has not set lower lows, even as the outlook has become more dovish than it was here. And so perhaps the dollar is already sniffing out the idea that if the U.S. is not going to purposely destroy the dollar-based financial order, we learned that here, and if it's not going to see the Fed deliver as many rate cuts as the markets want, then perhaps the dollar is oversold at this point. And this bottoming already hints that the Fed isn't going to meet the markets where they are, but that instead the markets are going to get pulled to meet the Fed where it is, to the detriment of stock markets. And that is macro money for today. As ever, we are here Monday through Thursday, right after Overtime, a show that I co-host with Dylan Ragan and Chris Vecchio, looking at the Wall Street close and where things may go therefrom. I am likewise writing for the News and Insights portion of tastylive.com. I'm commenting on the platform formerly known as Twitter and on Blue Sky at Ilya Spivak. If you're watching this on YouTube, like and subscribe. Macro Money is back tomorrow. In the meantime, happy trading.
The market doesn't stop. So why should you? Diversify your portfolio with stocks, options, futures, crypto, and more from Tasty Trade. Focus on the markets that matter to you. See the odds before you trade using curve analysis, IV rank, and more tools. Get industry insights that help you find your next trade right where you need it. Tasty Trade. Download today.
Class is in session. Dr. Jim Schultz is bringing the heat to Options Crash Course Live. This 90-minute show features Dr. Jim in his professional prime. All of the gimmies, none of the gotchas. Come early and grab a drink with Dr. Jim before class and stay for Q&A. The event is free, but space is limited. Register today at tastylive.com/events. It's not a lecture, it's a lifestyle.
The beauty of Thinkorswim was that we were different. From the name to the front end technology
was clearly what we wanted as traders. Second time around, I think we did a better job. Yes, we are known for our ability to support complex derivatives traders, but we also have the tools for somebody who's brand new who wants to come in on the first floor and work their way up to the top of the building.
The amount of time I spend interacting with our customers via email or anything else is pretty much my entire life.
To be so powerful and so valuable, and then to be that approachable, just amazing.
Where else are you going to be able to email a CEO, get response back?
But you know what? Before he even knew who I was just some idiot trying to learn how to trade. And he still would email and help me learn and everything like that.
Some people say it's nuts, some people say it's insane. You know, that's what I do.
Traders, start your platform. Tom Sosnoff and Tony Batista are hitting the road for their first ever live trading event, At Work by 11. It's unprecedented, unpredictable, and unlike any other financial event. Watch these masters make real trades in real time. Doors open at 8, the action starts at 9, and we'll have you back at work by 11. Sign up today at tastylive.com/events.
What's a macro risk right now that people aren't talking about enough?
Complacency is one. There's a lot of bullishness around. The street is very complacent. There's very little cash on the sidelines. And I think there's just, in general, the regulatory environment is too good. So people become overconfident.
I still think the geopolitical thing is very, very interesting. Frankly, I've had a tough time kind of parsing out the headlines in the news lately. I guess I would say like this ongoing discussion of just different conflicts that are going on and how it's pushing and pulling different asset classes. That's a super diplomatic answer. I'm not unaware of that. I think it's really important to kind of be mindful of your positions when there is so much talk and uncertainty going on and making sure that you're always controlling your size.
I mean, the dollar's depreciated over 10% against the euro and some other major currencies. I don't see how that doesn't start to play into some companies' earnings and their fiscal reports.
Ready to take your trading skills to the next level? Dive into the world of stocks, options, and futures with Tasty Trade courses. Whether you're a beginner or more advanced trader, our courses can empower you with the knowledge to succeed. Watch as our team in Chicago shows you how to use the Tasty Trade platform and go over the basics of trading. Perhaps you'll learn about a new strategy or a potential product for your portfolio. To find our courses, go to the Manage section of our web platform or head to courses.tastytrade.com. Start taking control of your financial future. Visit our courses today.
So I started trading in the equities market when I was 18. Real basic ETFs, mutual funds. I didn't discover options and really tastylive until about 2012. It made sense to me from a risk perspective. And so I started trading and never really have looked back. The people you see that's who they are. They're trying to be as open and clear as they can with the trades that they're putting on. Teaching a methodology, like teaching the logic behind things. It is tried, true, and tested. They back it up with research. They share that research. It's not just trust us and do this, which is a very dangerous thing in the financial world. But learning about that in the Tasty universe, it starts to prove itself out, right? When you follow the methodology, you'll see those profits and you'll understand why a position did what it did. Sometimes the market wins and sometimes you have a 90% winner and you don't know, why don't I do this every day, right? This is easy. But you kind of have to reset that and just go, okay, close the trade and move on to the next one, which is really what Tasty's about.
All right, we're back. Tasty Crypto Show. I'm Dan Cecilia, and with me today is a very special guest, friend of the show, Brendan Teven, better known as TiVo, co-host and producer of the Crypto 101 podcast and crypto market commenter. Tivo, welcome to the show. Thanks for being here.
Dude, appreciate you having me. I know you came on the Crypto 101 podcast on YouTube. We had a great time. You gave the Crypt Nation listeners, as we call them, an excellent pick. It was, I believe, Zora. It was the coin around kind of content making. You gave it, and like 10 days later, that thing was rocketing, and our team was talking about it. And I was just like, hey, we had a special guest on the rundown who's giving out alpha for free over at the Crypto 101 podcast. So it's an honor for me to be here with you after a call like that.
I mean, listen, that's what I'm here for. I'm just here to give out alpha, and hopefully the people kind of take it or leave it. But that's kind of hopefully I can continue getting things right. But it was really I really enjoyed doing the podcast. We've had kind of done this Tasty Crypto One collab a couple times, and I said, hey, we got to get you on the show. So, here we are. I guess getting into it, the last time we spoke, I think it was beginning of July or end of July, and we just had a big run up in ETH. Bitcoin hit an all-time high. I think a couple of things that I mentioned on that interview was that I would expect somewhat of a pullback or somewhat of a cautious optimism going into August, and here we are in September. Looks like we're trending sideways. So I guess I want to ask you, where are we in this cycle? We've seen this Bitcoin rotation to ETH and Sol. Do you think we still got legs here?
Yeah, I totally do. So basically, just to set the listeners straight, I am a commenter. I'm definitely one of the oddballs of crypto, if you will. Again, like you've heard, or for those who don't know, I kind of came from Barstool, so I have a lot more content experience. But also, my first job ever was at IBM. So I was introduced to Bitcoin back in 2016-17 when I worked at IBM. Ended up at Barstool, kind of went the content route, but always had kind of my hands on crypto, degenning into things, making a little money, losing a little money, making some more money, and all. Everybody knows the ups and downs of your intro to crypto. And then ending up at Crypto 101 and producing the show, I basically get full exposure to our team. So I'm sorry to give a broader picture, Dan, but I wanted to set the stage of like anything that I say, first of all, like yourself, not personal financial advice. I'm not a financial advisor by any means, but I kind of take in from all the awesome guests that we have, whether it's Matt Hogan from Bitwise or Jesse, Paul from Coinbase and Base. We've had on Canary Capital recently, Franklin Templeton recently. So I'm taking in all the experts of the space every week, along with our own team. So it's Bryce, Paul, Brendan Veeman, who's our technical analysis guy. Bryce runs the hedge fund. He's our big picture. He's our leader. We've got Rohit. We've got an analyst. He was from the Wharton School of Business. We've got meme coin guys. So I'm always interacting with so many awesome people that literally live in the trenches day by day. And I kind of get all this information plus the interviews parsed through. And then, I co-host and I spit out my own opinion. So with that said, what I'm really buying right now, Dan, what I'm really feeling is I am buying into this 4-year cycle is kind of gone, right? Everybody's kind of waiting for this big bust. The 4-year cycle's over. We had the run of Bitcoin, altcoins. Some have run, some haven't, depending on who you are and where you've been. And then eventually it's all gonna go kaput, and we're gonna go into this crypto winter that FTX threw us into so many years ago now. I'm not buying that. I'm buying into this kind of. I think it was Matt Hogan was the first one. Matt Hogan of Bitwise was the first one to kind of say this on the pod that the 4-year cycle is done. Not that we can't have a bear market, not that we can't have drawdowns, but this whole like 40 to 60, 70% correction in Bitcoin, I don't think that's going to happen anymore just because of all these ETFs, all this liquidity that's being unlocked. Ethereum's taking the narrative, which I know we're going to talk about, and moving everything on chain. So I'm super, call me a permable. But if I'm up there with Tom Lee at the end of my run as a permable, I'll be more than happy because that guy's been right for a decade now. So again, down for pullbacks, not believing in the 4-year cycle. I think we go up into the right continuously over the next 5 to 10 years, and I'm excited to be along for the ride.
Yeah, for sure. No, I think it's a great perspective, and I've noticed the market structure change a lot too since my time in the space. And you mentioned Tom Lee, you mentioned Matt Hogan. great company to kind of be with and to follow. But, to your point, last cycle or the last, 2-3 cycles, since this asset class has become, a major asset class, we didn't have the ETFs. We didn't have the market structure support. We didn't have the institutions kind of giving access to, retail to be able to buy this through vehicles like ETFs. So, I do think that 4-year cycle narrative probably it's going to be tested. And right now with the way the market's reacting, I think Bitcoin, it trades sideways. It might see some pullbacks, but we track it here at Tasty. The volatility of Bitcoin has consistently gone down over the last couple of years. So going from this massive, crazy, volatile, super thin liquid, nascent asset class to one that's now supported by, MicroStrategy, the ETFs, some of these other crypto treasury companies, along with access to major markets like, major exchanges and retail having access. I think it does support the asset long term. So to your point, maybe this 4-year cycle narrative is maybe it's kind of dead. So we'll see. I do think that, given everything that's been happening over the last couple months and the support from, some of the regulatory bodies, probably is bullish long term for this. So, I do want to shift a little bit because I'm interested in your thoughts on this rotation to ETH and potentially SOL, right? Like we saw this rotation inflows into ETH in July. Obviously, you've covered Tom Lee a lot on your show. We've been seeing him in the media. I just want to hear your thoughts, because typically this is how the cycle works, right? Everybody gets rich in Bitcoin. Then they take that profit, they rotate it to ETH. Then they take that profit and they rotate it out to altcoins or NFTs or whatever the flavor is of this cycle. But we definitely are seeing that rotation in ETH. I think we saw 9.4 billion of flows into ETH ETFs since July 1st. That's massively outpaced what we saw into Bitcoin. So just want to hear your thoughts there. Is ETH really going to 60,000 like Tom Lee's saying, or just what do you think there?
Yeah, I'm not sure if I'm able to share my screen real quick. I actually have a great take. Can you see that? Can you see that tweet? I know it's a little small. Are you seeing that, Dan, or no?
Let's see if the guys can get it on the screen. If not, you can.
All right, we'll do verbal meme, verbal tweet. This is a verbal tweet on X. So it's actually my fearless leader, Bryce Paul. So Bryce tweeted out this on April 22nd. He said, "I stand by my statement that the Ethereum revenge hike will be glorious." So that's what we were talking about over at the Crypto 101 pod in late April. We all know late April. We had the tariffs in April and the market fell out of bed. Crypto fell out of bed and this Ethereum was happening all over the timeline. I got to be honest, Dan, I started to have weak hands. My hands started to tremble. I went to my team and I'm like, listen, I've been a huge ETH holder since 2018-19, staked, haven't touched it. I watched Solana rip on all the meme coin stuff, right? There's that meme coin narrative in January. Solana's ripping, Ethereum's not following along. And then April, everything falls out. I'm like, hey, do I need to transition this? And my team, specifically Bryce, just said, hey, man, this revenge arc is going to be glorious. Don't, not financial advice by any means, but don't sell. LOL. And just, kind of where we are today. And again, I wouldn't say I did a full double down because that would have been a little much, but I bought the dip. And then Donna Sky, friend in the comments. I'm in on the YouTube, guys. I'm seeing the comments there. Appreciate you guys welcoming me to Tasty Live. Donna Sky said, could you comment on BMNR, Bitmine? And so we have covered Tom Lee. I'm a huge fan of his over the years over at Fundstrat. And as soon as they announced Bitmine, honestly, I missed it. That thing rocketed up. I think it was, don't quote me on it, but I think it was like a 10x in like a day or two. And then from that point on, I was like, I'm waiting for this thing to come back down. I'm waiting for this thing to dip. And then sure enough, I got in on some Bitmine on that. Okay, I see you guys are showing it on the screen. What a production crew. Amazing. Shout out to the crew there. Yeah, you can see kind of that dip from after that thing. I started building my position and, looking to add because I'm a believer kind of in Tom Lee, but also the kind of that Ethereum treasury play is taking the narrative from the Bitcoin treasury play, right? Michael Saylor's the king of it. Now everybody has one. Right now it feels like SharpLink and Bitmine are the two kind of front runners, and more are coming. So you're getting that narrative. Now the narrative's back. Now ETH is the belle of the ball. It's the girl you want to take to prom. Just in April, it was dead and you wanted to get rid of it. And Solana was the belle of the ball. So there's always these narratives in crypto where, okay, you can have good fundamentals, you can have good technicals, and then once you get both of those with some narrative, that's when things rocket. And so again, I'm a believer in Bitcoin, I'm a believer in ETH, and I'm a believer in Solana, and that's kind of where I'm going to finish off this take, Dan, is eventually what's going to happen is, and I don't think we're quite there yet, but I think Ethereum still has some more legs into the end of the year, especially when you have people like Tom on national TV literally every day pumping the bags. But eventually what's going to happen is these Solana ETFs are going to get approved. The Solana treasury companies are going to start coming out of the woodwork, and we're going to get some, Solana's faster. Goldman Sachs is going to use Solana. JP Morgan's going to use Ethereum. Eventually all this stuff, these narratives are going to dance and do tangos with each other. And again, I think a tide lifts all boats, but eventually at some point the wind's going to change sails a little bit. And I think that's an interesting kind of narrative that you want to look out for. And that's why you listen to Tasty Crypto, Tasty Live. That's why you tune into the Crypto 101 podcast. Because normally what I find, and credit to us, credit to you for picking winners, credit to us at Crypto 101. We've been talking about this Ethereum narrative for months, kind of leading up to it. And then to finally see it happen is awesome conviction wise.
Yeah, it definitely tests your conviction, but you've been a participant in the space. You're surrounded by super smart people over at Crypto 101. People see it. Like when you have that experience, it's kind of, your conviction gets tested, but it's what you do. You hold that conviction and you just know that rotation's coming, right? That narrative's going to hit. And, I felt the same way, right? Like I was there, last year listening to people say ETH is dead, all the commenters that, it's too expensive, it's slow, blah, blah, blah. But, if you actually are deep in the space and you're using it and you're listening to smart people and you're following, great content like you guys produce over at Crypto 101, like what we do here, you know that that's not true, right? You know that to ignore some of that. So it's kind of that asymmetric reflexive bet, right? And, you mentioned it too. It's where that narrative meets the price action. You get that huge spike, those huge reflexive moves. That's what makes this asset class so fun to trade. And then you're looking for the next thing. So, you mentioned Solana, you touched on it a bit, but are there any symbols that stick out to you? I think one I follow is UPXI. Upexi is one that's a treasury company that's just announced they bought 200 million shares. I know that those ETFs are going to be approved soon. Another one was Sharps, STRS, I think. Sharps Technology, STSS. Is there anything you're following there on the Solana front, or anything that you're taking a look at?
Not quite yet. Nothing's on my personal radar. We did have Soul Strategies on the podcast. They're a really awesome, interesting group that again are all about Solana. Right now, just because you can get great APYs on Sol, I'm just kind of a holder and staking, but definitely looking out for that ticker symbol that you might want to jump on again to get that alpha, like a Bitmine, right? I'm sure there's some out there that you can get some early alpha on, but I think it's more, and again, in my opinion, you're kind of waiting to see if you can get some early alpha on who's going to partner with one of those tickers to really take it to the next level, right? Because Bitmine was just a Bitcoin mining company, 2 months ago, and now with a low market cap, and now this thing's trading. Did you see that stat, Dan? It was like it's a top 10 stock in volume, in the entire stock market right now. It's insane.
Yeah, that is crazy. And like you said, when you got Tom Lee on every single major financial media network just pumping it, it's like, I don't know, man, this is kind of what I live for though with crypto. It's fun.
I had it.
Yeah.
I was gonna say I had it when you had on. I had to apologize because I was like on this Tom Lee kick. We just have an official Tom Lee segment, like literally on the rundown. We literally just every day. It's like every episode. It's just a segment now.
Tom Lee watch.
Yeah, it's Tom Lee watch. You got to pull one quote. I mean, that guy's putting out so much content. It's unbelievable.
Yeah.
It's unbelievable.
Yeah. Well, I want to shift a bit to just hit on some major news because I think it does sort of play into what we've been talking about with some of this rotation. World Liberty Financial launched on Labor Day, Monday, ticker WLFI. Ton of attention. Mainstream media obviously picked up on this. It launched and went down, so it kind of pulled back a little bit. Let me bring up the chart here, but you know, I guess
it's not a good looking chart.
Not
man.
a good looking chart. No, not at all. I was looking at, I was trying to do some research before this into kind of what it was because I wasn't deeply following it. I just know it was something people were talking about, but apparently this token gives you governance over US dollar one, which is the stable coin that's launched by the, Trump family. I was reading some news here that this WLFI World Liberty launch netted the family $5 billion in paper profits. But just want to hear your take on this, just briefly, if you have any thoughts on this or if you guys covered this at all.
Yeah, I like that term, paper profits.
Yeah.
I've heard profits on paper. I don't think I've ever said that paper profits. I like that. That's smooth. No individual take on World Liberty Financial, to be quite honest. Obviously, high risk could have been high reward, maybe the other way if you bought in. My theories on this, and it's kind of, I think on the next segment you have teed up with kind of the more legislation side of things, where things are going right now. My take on the World Liberty Fi is, if we're playing hockey, you don't want to skate to where the puck is. You want to skate to where the puck's going. And just legislation-wise, and World Liberty Fi goes into this conversation again because, take your politic hat off. I'm not a politics guy. I'm a crypto guy. And so, we can kind of see where the puck's going. Again, the president of the United States, the most powerful country in the world, his family owns a crypto company. His family's involved in stable coins. His family's now involved in Polymarket. So where's the legislation going to go? It's going to go in favor of these assets to keep moving them forward. So, is World Liberty Fi coin a buy? Well, you got to dive into the tokenomics. You got to do your own research, and you got to, figure out what the upside to that specific project is. But as a whole, in this space, I mean, I don't want to speak for you, Dan. I just think we couldn't be in a better area to keep making content, to keep educating, to keep investing, to keep doing our research, because kind of like I opened up with Bitcoin is I think it's up and to the right because the runway is clear with legislation for the next 3 years. Yeah,
for sure. And you touched on it too. Like, I think, obviously the president and his family launching a token and a stable coin is supports the industry. But also you had the CFTC and SEC announce a statement to support U.S. exchanges to offer spot crypto products, including margin and leverage products, and futures, perps, and the like, derivatives. I think like this goes hand in hand with the fact that, this administration's supportive. We have regulatory bodies on board. All of this I think bodes well for the industry. What we're doing, it supports kind of this narrative. So, I mean, I just generally think a lot of this coming out right now is, to your point, like maybe the 4-year cycle is over, right? Like we haven't seen this before in past cycles. So, I don't know if you saw that statement from the CFTC and SEC, but that was pretty big, I think.
Yeah, it's all about clearing the runways, whether it's kind of crypto IPOs, which I know you wanted to talk about in this segment as well. But the legislation's coming. I think there's going to be clear winners. You got to try to find them. I mean, in my opinion, and I'd love to hear yours. This is kind of something we've been looking into is like, is this legislation, is there going to be a world where Binance might be the biggest winner if they get, obviously everybody kind of knows Binance is the largest and the biggest in the world, and then Binance US not as good. Is this going to open up the floodgates for somebody like Binance? Is World Liberty Fi going to get kind of the red carpet to be a huge winner? And then obviously with the crypto IPOs, the Krakens, the Geminis, the Weebles, like it's an absolute parade, whether it's TradFi or crypto, for legislation and just coming to the markets.
Yeah, exactly. And, I do want to touch on some of the IPOs that went live, these crypto IPOs, but, I think one of the things that's interesting to me about this legislation, this regulation coming for the industry is, does it boost stuff, companies like Binance, companies like OKX, Coinbase, Robinhood, or does it boost legacy companies like CME, SIBO, NYSE? Does it carve out, something for the incumbents? That's where I wonder, where that tension will hold is, does these regulatory bodies, especially in the States, is it giving a boost to incumbents, or is it allowing for more competition to come in from some of the major players like Binance? So, that'll be something we'll have to pay attention to and look at. But I think is specifically to this CFTC and SEC statement, it allows the new U.S. exchanges to offer these products, which is something that I don't think they really have done before, at least spot products. So, we'll take a look at that. It's definitely something I'm paying attention to, given, that's what we do every day. So, real quick, I did want to touch Gemini. So another exchange, Gemini, Winklevoss Brothers, they announced their IPO, the plans to IPO for the company Galaxy, which is another crypto investment company, went live bullish earlier this month, earlier in August. Do you think some of these IPOs is this late cycle activity, you think, or is it just, hey, let's take advantage of it, it's open season?
So glad you asked, Dan. And this has been a take that I've had over at the Crypto 101 podcast for a while now, about 3 months, since Circle, to be quite honest. And with Circle and I think you got to throw Robinhood in there, not because it's an IPO, but because the absolute rocket of a move that it's had the last year to 2 years. I've been touting that everybody's been, and there have been altcoins that there's been winners for sure. But this whole when's altcoin season? Altcoin season's not coming. Altcoins are dead. I'm like, guys, altcoin season's happening. It's just happening in the traditional finance market with these IPOs and with Robinhood and with Coinbase. It's like, again, there comes back to that regulatory kind of holdback for a lot of these massive funds where they can't necessarily go play with client money on a DEX and on Coinbase even, until this stuff gets regulated and there's time where these assets kind of get evaluated before they can really dive in. That's why you're seeing tons of flows into Bitcoin ETFs, ETH ETFs, because that's, what's approved, not necessarily, when these altcoin ETFs get approved, which they will, in my opinion, in the next year, but it's still going to take time for them to get evaluated so these giants can start piling money into them. They can't log on to Coinbase. They can't log on to Uniswap, and PancakeSwap and just dive in and start buying stuff. So you're waiting for altcoin season, and it's happening right before you in the IPO markets and with Robinhood. Again, in this industry, you always want to give a credit to me. I know I sent you that video. Like, one of my best calls ever on air was Robinhood. We interviewed Johan Kerbot years ago when he was named the GM of crypto. And now he's giving, the speeches on the Robinhood Lives about what they're announcing. He came on our pod and pitched us this vision of Robinhood crypto. And I went on our podcast after, and I was just like, guys, is anybody counting crypto into Robinhood's price at $8.50 a share? And the answer was no. I put a call out there. I was like, hey, if crypto and Bitcoin take off, Robinhood's going sky high. And that was at, again, $8.50. And we rode it all the way to 100. So that was an absolute W. Took some wins, and as I told you before the show, I was running late because I'm closing on a house. So that's what you can do if you listen to Tasty Live and Crypto 101.
Yeah.
You can ride the fun. You can ride the fun wave with us. Not personal financial advice.
Yeah, you're gonna
join us and educate. You can educate.
You're gonna have to give credit to Vlad for that house you're closing on, huh? That's all Robinhood 100%.
My whole team makes fun of me because I'm the Robinhood guy, and I love crypto and I love decentralized finance. I'm all in. Trust me, I'm all in. But I do have a soft spot for Robinhood. When you make some calls, some call options, some leaps on Robinhood at $10 a share, and you ride that wave, it's one hell of a ride.
Yeah, no, that's an amazing feeling, amazing call as well. I mean, I think that's so interesting too, because I don't know if I mentioned this when you had me on the podcast, but one of my best calls was a similar sort of setup where I was Coinbase. Coinbase was at like $30 in 2023 after the FTX blow up, and they, people were calling for the end of the industry, right? Crypto was going to be outlawed, and you just get those overreactions. And I'm sitting here looking at Coinbase, Brian Armstrong, the CEO, just all the investors, right? Like, I'm like, no, this is like the next JP Morgan, I thought to myself. So I put a call out in the Tasty Crypto Discord server. I don't know if anyone in the chat was in there, but I was buying Coinbase $30, $40, $50 back in 2023. And, lo and behold, it goes up to 300. So those opportunities are out there. And I think you just got to be paying attention. But yeah, amazing call.
And you got to educate. Like, again, this channel, Crypto 101, I keep saying it, but like, I only did that because we had them on the podcast, and I listened to him get interviewed by Bryson Brendan. It was a great interview. And I was like, I don't think I've ever heard anybody talk about Robinhood like this. Like, this is wild. This is the future. This is what we believe in. So you really got to consume content. You got to educate. And if you're listening to this, you're in the right place.
Yeah, for sure. So we got a few minutes left. Any guests we have on, I do want to kind of get your price prediction. But before that, do you think we're getting an altcoin season? I just want to hear your take. Like, what would be the indication that altcoin season's coming?
I think kind of building off what I just with the rant I went on with, IPOs and stuff. I think it's coming for the altcoin market. I know our team truly believes that. I also think there's opportunities kind of there where, like, you don't want to look past, not being in the moment, where there's really a ton of opportunities, or there has been. I think we're kind of in that cool off period now, and we're going to ramp up into Q4. So we had that. There's been tons of opportunities coming into the new year. Clearly with the tariff despair and the April bottom, there was tons of opportunities. I remember we had Syrup on for an interview on the podcast around April, and I heard their pitch for Syrup, and I was like, you know what, I like this, and went in on that, and that really rocketed up. So I like Syrup. I do think there will be a day where there's going to be those face ripping altcoins. I think it'll come. I don't know how to really tell you when and where that's going to be, because I think kind of to that narrative that Bitcoin led us for kind of the first half of the bull market and into the second half, where everybody, when's Ethereum coming? When are altcoins coming? I think you could have really big rallies in these blue chips, kind of to what we talked about at the beginning of the program with like Ethereum and Solana and Bitcoin, is like, because these ETFs are coming. So you're getting the ETFs, more liquidity. You're going to get these treasury companies for now Ethereum. I think there's going to be a ton for Solana, more liquidity. Of all of them for Bitcoin, more liquidity. And then once these ETFs are approved and there's time spent for these bigger, hedge funds and money managers to evaluate. Again, their rules don't allow them to really jump into these things until there's 3-6 months, maybe sometimes 8 to 12 months of price action. So, you gotta take into effect that there's a wave of liquidity coming for these blue chips first, which again is altcoins, and then that will obviously funnel down into the rest of the ecosystem.
Yeah, for sure. I know we touched on it. I just, specific tickers or anything. We'll have to revisit this.
Okay, yeah, I got two. I came with two. Okay, I'm a Pengu believer.
Okay.
Pudgy Penguin. Shout out to Joe and Brian. They're our meme coin. We call them Momentum Moneymakers. They're our meme coin guys. They've been on Pudgy Penguins forever, the NFC, literally. And then when Pengu came out, they said, hey, this is something we're really interested in. And then again, you'll see like late March and then into April, you see it under 10 cents. And they put out alerts to their community that, this is again, not personal financial advice, just educational and fun. This is an absolute hammer of a buy. So yeah, I was collecting Pengu under 10 cents. Super happy about that. I love Luca Nets. I think that guy is a visionary for just content creation, community building. He's taken what a meme coin is just like a gambling casino, and he's turned it into a brand.
Right.
And he takes that stuff very, very personal. And I'm a huge fan. He's on my GOAT list to get an interview. So if anybody can get us a contact Luca Nets, we'd love to have him. So I'm a Pengu guy, and I do like Arrow. I think Aerodrome Finance, you're sticking around in the base, the base category. which is connected to Coinbase. That's kind of, the theory on that, right? You're sticking to the whales of the industry. And so, Aerodrome Finance has a tight connection to Base. Base is connected to Coinbase. Again, not a super deep analysis there, but I think you want to swim where the money is. And Coinbase clearly is a huge legendary whale in the space.
Yeah, no, those are both great calls, great tickers. I wrote about Aerodrome for any of our listeners that follow or subscribe to the Tasty Crypto newsletter. I wrote about Aerodrome as one of my picks back in April. It was at 40 cents. And I actually had some jokes with some of the guys on the research desk at the office, and they're just like, I don't even know where to buy this thing. They're not crypto people, but I was trying to get them into it. And I was like, listen, man, this is anointed Coinbase stock, or Coinbase ticker. So just kind of, pay attention to it. And yeah, here it is at $1.17. So yeah, two tokens that I definitely,
I think, dude, around that same time in, April, March, we had Aerodrome on the podcast, like same time you put that out. So again, I could go through, I gave the two examples. I like Sarah too. So you just get the alpha from the educational process, reading Dan's write-ups, listening to the Crypto 101 podcast. Like, we're bringing on people that we're interested in. So again, it's not everybody we come on is probably something that's right for, your capital, depending on how you do your, investment research and want to make your own decisions. But, it's all about education. Like, all the stuff that I do is based around consuming content, meeting people, interviewing people, and talking to my team over at Crypto 101, which we have a hell of a team. And you can't, I think we talked about this when me and you were on, you can't do this alone. Like, there's a lot of people in the trenches and they're, oh, I just do this alone. I don't talk to anybody. I don't believe that. Everybody has a community. Everybody needs a group. And again, you are, as a trader, you are out there on your own, but like having that community and bouncing ideas off each other and consuming content together and sharing tweets, sharing podcasts, it's like, that's what makes this truly such a unique, fun space. And I think the more you do together and the more you have an awesome community, the more successful you're going to be.
Yeah, for sure. I couldn't agree more. And, that's kind of how everybody learns, right? You just can't do this alone. You can't do this in a vacuum. You got to get out there. You got to talk with people in the space, listen to, consume content, take your lumps, take your licks, and just, keep participating in the space, keep paying attention, keep trading. So, I love that. One last thing, I got to do it because we do it with every guest. Can you give me your price predictions for Bitcoin, ETH, and Sol?
Yeah. So we do this at the end of the year.
Yep.
Each year. And so mine literally was 169. So last 2024 December was 169 for Bitcoin. So I'm still in the running. I'm going to stick with it. That would be pretty cool to be able to pull that clip and be like, yeah, I said this exactly a year ago. So I'm going for, 169 for Bitcoin. Can you pull up the Sol chart for me? I haven't looked at the Sol chart in a couple of days. For Ethereum, I think we make that run, right? We're going to make that pop. I think we're going to break that 5K number. I'm going to go with, we'll go 6,900 for ETH. You can tell there's a theme here.
We're
169. Nice for Bitcoin, 6,900 for ETH. And then, for Solana, let's see here. We're definitely going to, you think we're going to break that support?
I mean, I do. I just think Solana's the next narrative. I think that's the next narrative. I know we had that meme coin. Yeah.
No, sorry. Go ahead.
No,
ahead.
I just
coin phrase. Do you think that's going to come back? Do you think the meme coins come back by the end of the year and like kind of take the forefront, or you think this is a blue chip lead off?
I think that meme coins kind of are the NFTs of this cycle. So I think that there's going to be a lot more with that creator, that like content coin, creator coin, that narrative I talked about with you last time with like Zora. I think Solana with all their launch pads, you'll get a couple, really high attention influencers that'll launch a token, and that's kind of what'll take off. Right now, we've kind of, with these meme coin launch pads, we've kind of had this like, I don't know, just anons or just funny memes or whatever, but we haven't had like the Kai Kinets or the Mr. Beast launch yet, and I think we'll see that next. So
I'm gonna go. All right, my Sol price we're gonna lock in. It's 333. Lock me in at 333.
Okay.
169 for Bitcoin, 6,900 for ETH, 333 for Solana.
Awesome. Okay. Well, hey, before I let you go, Tivo, can you let the audience know where can we follow you at? Where can we find you?
Yeah, if I haven't pronounced it enough, we're over at the Crypto 101 podcasts. If you're on X, it's at Crypto 101 Pod, and then YouTube, Crypto 101 Podcast. Obviously, Apple, Spotify, everything. We've had Dan on before. He was awesome. We'll have him back for sure. But check us out. We have a lot of variety, like I talked about with Bryce and Brendan with interviews. We do technical analysis with Brendan. We've got meme coin specific updates. We really have a buffet of content over there, from interviews to kind of rundowns like this and tutorials. So check out the Crypto 101 podcast, YouTube, Spotify, and X. Appreciate it.
Yeah, appreciate you. And, that's all we have for today. We'll see you guys back here on Monday. With that said, I'm Dan. Peace.